Welcome to the Global Commerce Academy, your trusted platform for 100% free CMA USA classes. Today's lecture is from Part 1, External Financial Reporting Decisions of the CMA USA 2025 syllabus. We're diving into Chapter 7, Recognition, Measurement, Valuation, and Disclosure, one of the most important foundations in financial accounting. So let's start with Topic 1. What is recognition? In the world of accounting and finance, recognition is a fundamental concept that forms the backbone of how companies report their financial activities. But what does it really mean to recognize something in the financial statements? Let's break it down step by step. Recognition means formally recording an item in the financial statements. This isn't just about jotting down numbers, it's about officially acknowledging that a transaction or event has occurred and meets specific criteria set by accounting standards. When an item is recognized, it becomes part of the company's official financial record, visible to investors, regulators, and other stakeholders. To recognize something, it must meet the definition of an asset, liability, equity, income, or expense. But that's not all. It also needs to be both relevant and reliable. Relevance means the information can influence decisions, while reliability means it can be depended upon to represent what it claims. If an item doesn't meet these criteria, it isn't recognized, even if it's important in other ways. For example, imagine a company that has provided a service and earned revenue, but hasn't yet received payment from the customer. According to the rules of recognition, the company may still record this revenue in its financial statements if the earning process is complete and collection is reasonably assured. This approach ensures that the financial statements reflect the company's true financial position and performance, not just the cash that has changed hands. Recognition, therefore, is about timing and certainty, making sure that only the right items at the right time are included in the financial story a company tells the world. Now, moving on to Topic 2, Measurement Basics. In accounting, measurement is a fundamental concept that underpins how we record, report, and interpret financial information. Without a clear understanding of measurement, it would be impossible to compare financial statements or make informed business decisions. Measurement provides the structure and consistency needed for reliable financial reporting, which is essential for investors, managers, regulators, and other stakeholders. Measurement, in its simplest form, means assigning a monetary value to the element recognized in the financial statements. This process allows businesses to quantify their resources, obligations, and performance in a way that can be understood and analyzed. For example, when a company purchases equipment, measurement determines how much that equipment is recorded for on the balance sheet. There are several different measurement bases used in accounting, each with its own purpose and application. The choice of measurement base can significantly impact how assets and liabilities are valued and reported, which in turn affects the financial position and performance of a business. The first and most traditional method is historical cost. Historical cost refers to the original purchase price of an asset or liability at the time the transaction occurred. This method is widely used because it is objective, verifiable, and easy to understand. For example, if a company buys a machine for $10,000, it records that machine at $10,000 on its books, regardless of how the market value changes over time. Another important measurement base is fair value. Fair value represents the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. This method reflects current market conditions and is often used for financial instruments, investment properties, and certain types of assets and liabilities that are actively traded. Net realizable value is another measurement base, particularly relevant for inventory and receivables. It is defined as the estimated selling price of an asset in the ordinary course of business, minus any costs necessary to make the sale. This approach ensures that assets are not overstated on the balance sheet and reflects the amount the company actually expects to realize from their sale. Present value is a measurement base that involves discounting future cash flows to their value today, using an appropriate discount rate. This method is commonly used for long-term receivables, payables, and other financial instruments where the timing of cash flows is critical. By considering the time value of money, present value provides a more accurate picture of what those future amounts are worth in today's terms. Each measurement method is chosen based on the specific situation, the requirements of accounting standards, and the nature of the asset or liability involved. Understanding when and why to use each measurement base is crucial for accurate financial reporting and compliance. By applying the appropriate measurement basis, accountants ensure that financial statements provide a true and fair view of a company's financial health, supporting better decision-making for all stakeholders. Next, let's discuss Topic 3, Valuation in Practice. Valuation means determining the right value for financial statement items based on recognition and measurement principles. For example, if you're valuing inventory, you'd use the lower of cost or net realizable value. For investments, fair value is commonly applied under IFRS and GAAP. CMAs must understand when and how to apply these valuations for accurate reporting. When we talk about disclosure principles in accounting, we're really talking about the information that gives life and meaning to the numbers you see in financial statements. Disclosures are the narrative and details that help users understand what's behind the figures, why certain numbers are what they are, and what judgments or estimates went into them. They provide the essential context that allows investors, regulators, and other stakeholders to make informed decisions. Disclosures typically include a wide range of information. For example, they spell out the accounting policies a company uses, like how it values inventory or recognizes revenue. They also explain the key assumptions and estimates made by management, which can have a big impact on reported results. In addition, disclosures cover any contingent liabilities, such as potential lawsuits or guarantees, that could affect the company's financial position in the future. But that's not all. Disclosures also address risks and uncertainties that the business faces, such as market volatility, credit risk, or operational challenges. They even include information about significant events that occur after the reporting period, but before the financial statements are issued, events that could influence how users interpret the company's financial health. Without thorough and transparent disclosures, financial statements can be misleading or incomplete. Users might be left confused or even misinformed, unable to see the full picture of a company's financial situation. This lack of transparency can erode trust and lead to poor decision-making by investors and other stakeholders. That's why it's so important for certified management accountants, or CMAs, to ensure that disclosures are both full and fair. They must comply with established standards, such as ASC 235 in the United States and IAS 1 internationally. These standards set out the requirements for what must be disclosed and how, helping to ensure consistency, comparability, and reliability in financial reporting. Both US GAAP and IFRS provide rules for when to recognize revenue, expenses, assets, and liabilities, as well as how to value them over time, and what minimum disclosures are required. For example, GAAP follows rule-based recognition, while IFRS is principle-based and may allow more judgment. Understanding these frameworks ensures compliance and comparability. Imagine a company selling software with an annual license. Revenue is only recognized as it is earned, maybe monthly, not upfront. The cost of delivering that service is matched each month too. This shows how recognition and measurement work together, and why valuation and disclosure make the financials meaningful. As a CMA, your job is not just to record, but to interpret, apply, and explain. You must ensure your team applies correct recognition rules, measures values properly, and discloses assumptions clearly. This ensures compliance and builds investor confidence. To summarize, recognition decides what goes into the books, measurement tells us at what value, valuation applies context-based techniques, and disclosures complete the story behind the numbers. Subscribe to the Global Commerce Academy and continue your CMA USA journey, full syllabus, fully free.